Hey everyone, hopefully you're having a good day. My name's Andy, channel's Finding Value. Today we'll rip through Twitter. We'll rip through a little bit on oil, perhaps, what's going on there. It looks like everyone and their mom is negative. Maybe it's justified, maybe it's not. But we'll take a look at that as well, go over some information there. There's some oil in this. So we'll rip through it. We'll talk about commodities, a little bit about wealth topics and or financial topics could be intermixed in there. So let's dive in. Let's take a look and see what's going on in the markets. We've got, if you want to follow me, it's at finding_finance. And if you want to join our community, it's finding-value.com. We do have a trading session coming up Wednesday, 8:30 a.m. For those interested in attending. It will deal with technical analysis and go into a little bit about the human psychology behind some of the patterns and buying during certain periods where basically everyone's going to disagree with you. That's kind of what the bottoms feel like. So there is some trading coming up there. So coming on down, we've got nat gas. Martin posted this. We've got some cold weather coming up. Probably going to draw on natural gas and some of the inventories, which is well needed. We've had a pretty warm winter so far. So we've got cold weather coming. At least here it's pretty cold, and it's covering the majority of the United States. The crude oil, I know that we are in this downward facing channel and we're trying to break out. We could get a reversal candlestick here. Looks like we're selling off today. So we could easily stay within the channel. Um, so we can go and jump over to the YouTube comments. A lot of people say oil looks terrible here. I think it's headed to sub 40 before it goes to 80. Coming on down, and this a lot of it was real estate and oil comments that I was reading through. Ratios are great, but you should talk to a few companies of each, or talk a few companies in each sector. I leave the companies to people on the website. If oil's $300 a barrel, so when I talk about oil going up, it's driven by credit, not necessarily the uh, supply demand that I think most people think about it. Oil is driven by credit expansion. So a slowdown could occur in credit expansion, and that's what's going to hit oil is that credit slowdown. But I think there's going to be another wave of credit, and that wave of credit is going to come after this slowdown that we get in the short term. It'll be another liquidity cycle run and credit, but that doesn't mean it'll happen immediately. So a lot of people think demand supply, it's the demand of credit versus the supply of oil is what I'm measuring. And I've got some charts later on. It shows that. And the credit generally, at least historically, has come from the real estate market. And the real estate market is what generates that credit. It gets it into the hands of people. And oil being the number one commodity very well could drive it up to levels that are very high. But that's almost always occurred during expansionary phases of real estate historically. There's also fiscal spending and spending that occurs with interest payments because the government is so much into debt, which I also will think impact the pricing of commodities. So it's more or less not so much about oil itself. It deals more with the denominator of the value of the dollar that I'm talking about. Now, that doesn't mean that it's going to go straight there. We could go lower in oil, very possibly could go lower, just like the negative sentiment is out there. But generally, at bottoms, that's where negative sentiment is the most. It's very close to a bottom. So, but I don't think if oil's $300 a barrel, bread's not going to be $30 a loaf, and it's not going to cost $1,500 to fill up your tank of gas. It's we went through a period in, I think it was 2021, 2022, where gas was $4 a gallon, and it was five, six, $7 depending on where you lived, out in California, maybe even New York, that have higher taxes on it. That was a spike in refining crack spreads. That spike in crack spreads, if we don't get a spike in crack spreads and oil is the driver of the gasoline price, we would have $250, $300 oil and gas would be that same price if crack spreads remained low and oil was the driver of the shortage, so to speak. Coming on down, hopefully it's not like the 20-year period between 57 and 75. That's where we had low commodities for a good long chunk period of time. That could be a possibility, though. There's nothing stating that we have to roll on up immediately. Uh, it's all credit driven, though. Credit drives all this stuff. And I'll show you a chart of why that is with someone else who charted it. I think it was Patrick who charted it. Um, It says so many analysts on CNBC and Bloomberg are saying there's an oil supply glut developing. Russia and Iran, especially, are pumping a lot into the system. I've heard 80 to as low as $10 a barrel. Bloomberg really is bearish on oil too. You were probably thinking you did the video by showing the historical pattern today, but these bearish guys don't do ratios and fractals. Yeah, so if we get pushed lower in the short term, which I mean, obviously it's a possibility, um, that's going to give you a buying opportunity in oil. These guys, they do look at production, and the thing that's more bearish, it's not necessarily production or a potential glut. It would be more in line of lending. And the slowdown in lending is where I think I would be more bearish. It's the potential slowdown in the markets from the decline of interest rates. Now, if the decline of interest rates ramps up credit expansion, that's going to be bullish for oil. So I'm more on the credit side. And a lot of these guys are looking like barrel counting this stuff. So that's kind of the difference there. Um, it says, I'm confused about crude oil. I'm hearing we have plenty in the US and no shortages. US production's at record level. Well, so here's another thing. They're now increasing natural gas liquids in that number. So that number isn't 100% oil. They've added natural gas liquids into it. Our inventory levels are still quite low, and if you were to look at a linear regression analysis of where commercial inventory levels are at, the fair value of oil at this time is $77 a barrel. That's if you're looking only at commercial oil inventory levels. Now, if there is a glut, we would see inventories go up. That is what we're going to see. Or if there's declining or decreasing demand. And that's where this guy says the glut is suppressing prices right now. Yeah, you're confirming that we're at a bottom. Maybe we're at a bottom. Now, I'm not saying that we're just going to go shooting higher. We could easily bounce around at this bottom for a while. So again, we're at a very cheap ratio. We can look at some of this stuff too here real quick. So here's oil today. It's down 3.2 something percent. And we could easily bounce around here, but we've got a broken downtrend line, right? Here's your, and you can extend this up if you want, something like that. But here's your downtrend line. We've broken through that, and we could easily bounce around here. We could even go down to $68, and it still isn't bad. And I would say breaking below 65 could be a little bit rough. That could be rough. But right now, we could easily tag 66, $65 a barrel in the short term. But I think that we're trying to put in a bottoming process here, in my opinion. And obviously, if we take, gold to oil ratio, something like that, we're at a very cheap level of 28.4. Very, very cheap. And to me, this looks like we're up against resistance. And we'll see if this resistance holds or if we break down or break higher. If it's bearish and crude oil is going to crash because of a slowdown in the market or something like that, the ratio is going to go up. And if we're strong, the ratio will compress over time. So let's keep going through here. So we're there. It looks like we were down today, so we could be heading a little bit lower in the short term. Here's another one. It says a great visual on how insane the pre-GFC capacity built was on oil. US housing was similar. So the Fed consensus is still that the post GFC period shows you can run super loose monetary policy and not get inflation. That's not true. It was all lapping a glut in energy and housing. So we did have a glut back in 2008, but I think the glut was created based off of the destruction of credit in the system. So even, I mean, here's reconstructed oil and gas capex. You can see we had some massive increases in capex in 2007, 8, and the echo boom. And that was credit driving this after 2009. They loaded the system with a bunch of stimulus and it had, I'll call it an echo boom up, and then it came down. And now we're in the valley of despair. We're at very low oil and gas capex. Now, that's where I find comfort is that we were coming from a bubble in 2007 and then back in the early 2010s. And now we're at very low capex spending in relationship to that high capex spending. So usually you go into the valley of despair and then you come and cycle back up again. Then we go into a valley of despair where we're at, and then I think we'll come and cycle back up again. That oil and gas capex is going to help energy service companies. And that's why I think energy service companies are going to do very well over this next cycle. Now, I don't know if we're at the bottom of the cycle yet, but I know that there's going to be a cycle that's ahead of us. Anybody who does the math realizes it is literally impossible for the US Treasury to meet its funding obligations without expansion of the monetary supply. Now, that's also going to be, I think, inflationary. And if you've got inflation and credit coming into the system, that's going to support commodity pricing. So it's the combination of an expansionary phase of real estate and this spending that we could potentially get in the US because of their fiscal situation. That's why I'm bullish on it. Home buyers don't shop by price nor mortgage rate. They shop by the monthly housing expense they believe they can afford. Obviously, price and rate determine that monthly expense. Here's the impact of both if they want to keep mortgage payments at about $2,600. And you can see what their loan amount is given the interest rate. You can take a $420,000 loan at 6.25 versus only a $360,000 loan at 7.75. And the interest rate is driving that movement up and down in terms of loan amount. Now, I chopped off of price, not necessarily mortgage rate. And what happened with me back in the mid 2010s, it was 2017, and I tried buying cheaper homes. I just couldn't do it because there was too many bids. People were bidding too far over the asking price. And I was just losing those. So what I did, that price back then was 250,000 to 350,000. There was just so many buyers and able buyers, willing buyers at that time that a house in the $300,000 range would get 15 bids on the first or second day, and then they would go through all the bids and they select the bid. So what I did is I had to go higher in price to basically get away from the bidding wars. So I had to go to the low 400s, and that's where I eventually bought a house there. Now, I think it's difficult to find homes in the 400s. Even the low end of the homes is in the 400s. There's just not that many homes available, and they go very, very quickly in that price range. Run it down. Coinbase is trapping my funds for 2 months with no explanation as to why. I can't even trade out of my positions. This is egregious. Nobody should use an exchange that does this, centralized trash. Well, I think that's the problem with a lot of these cryptos is the on-ramps and off-ramps of cash to whatever crypto you want to get into. They are trash. That's and that's I don't know. It seems very complicated to buy this stuff, and that's what I just have avoided it. I don't want to get into it. I do think it's a I don't want to give my opinions. People don't like my opinion. I'll just say that. Everyone is so long QQQ's highest institutional allocation ever. Just had the second greatest window of retail buying in 20 years, all in QQQs. HFs are over allocated. CTAs are long. peak relative price to earnings versus mid cap. Running out of incremental buyers here. So everyone's piled into the NASDAQ, seems like. And I would say probably the most negative sentiment I've seen in a long time is in oil. Oil's got a very negative sentiment. We can see that the net long position is just blown out to the downside. I think I have that next or somewhere in here. So we can talk about that next. Crypto has killed all my motivation to work. All I can think about is trying to 10x my money and retire. I do not want to work anymore, and my career is suffering because of it. I wonder if that's actually true, but I think that's what everyone is looking at crypto. They just want to get the the purchasing power from it and leave. It to me it feels and looks like a bubble because this is what I see the majority of people. A lot of my motivation to work, they're just there because they want to 10x their money. They don't care about crypto. I don't think they. Here's the best thing you can do is say, okay, take away all of the money that you can make from crypto, take that all away, and then just say, what's the actual utility of it? Is it good at being a currency or transacting or whatever? The answer is no, it's not. So then it's people try to say it's a store of value, and that's where it becomes very debated. And then your on ramps and off ramps for it, I think, are pretty poor. That's all got to get better for me to even start to look at it myself. But the early adopters are definitely the ones that are going to make all the money. Totally agree. Crude oil, inflation, and purchasing power. It says there's striking similarities between 98, 2001 and 2020, 2023 periods. A breakout for crude oil will foretell more purchasing power destruction alongside increasing inflation rate. And that's exactly what I mean by credit expansion. So if you look at history and you were to look at this chart here, we've got purchasing power, which is inverted of the currency. He inverted this, inverted scale. Then he put the price of crude oil above it and overlaid those two. Now, if you look at the yearly inflation rate, it's positive for vast periods of time, has crude oil chart oscillations skewed upwards. So the oscillations in the inflation yearly rate are very similar to what oil is. And these were driven under um, home price appreciation and expansionary phases of real estate. Credit was coming into the system during this period here. We also had credit coming into the system from 98 all the way to 2008. You can see the movements in all of this. So what I'm saying is inflation and the credit expansion is what's going to drive oil higher. It's not necessarily going to be a barrel counting situation. It's credit coming into the system, putting everything into a shortage. The same thing occurred in the uranium market. The uranium bull markets in the 70s and in the mid 2000s occurred at the same time that oil went up. And it was the credit expansion that caused it. The inflation coming into the system, the money rotating. So that is what had caused that. We had plenty of uranium in the 1970s. We had a bunch of inventory, but the price still skyrocketed during that time frame. Why? Why did that occur? It's the credit coming into the system at a faster pace and money rotating and finding other assets. And oil is the same exact way. It's that rotation of money. Another thing you can look at is you can see that we've got a breakout here. We've broken out and we're sitting on top. Now this easily could do a retest all the way back to the continuation breakout line, where we come back into the 60s or something. Very possible. But that's what we've got at this time. That's kind of where we're at. So I think it's credit driven. And the credit driving it is the most important thing. Because when we look at history, this isn't inventory levels driving it. It's credit driving it. Credit going up puts it into a shortage. And that's what occurred here. Credit drove this up in 2021 all the way up. We were in a glut in 2020. And then demand came back. Demand is the credit expansion. So credit expansion is, I think, the most important thing when looking at the pricing of commodities. And almost always we get credit expansion during the expansionary phase of real estate. The thing is, did the stimulus money in the system push the interest rates to a level where we're not getting credit expansion? So when we go and we look at stuff like credit expansion here, let me open this up a little bit. We go and then we look at, like, I think it's that, yeah, real estate, all loans, commercial banks. We're still coming higher with credit expansion from the commercial banking system. You can see the slowdown here in 2020, and then we rip it again. But I mean, you can see that we are slowing down in terms of its rate of expansion versus, this big, gigantic move all the way to about December of 2022. You can see it's kind of turned over, and the rate, your 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 rate of expansion is definitely not as steep as this rate of expansion there, but it is still going up, still going up. This is your expansionary phase of real estate. So this is single family permits, 5 units or more. If you look underneath, you can see the 5 units or more are down, but the single family units are higher. We had a mid-cycle wobble, and the beginning of the commodity bull market was from 1998, 99. The beginning of the commodity bull market was here, and it ended in 2008, which here the housing starts peaked in 2006 roughly. Add about 2 years, and that's the momentum in the system. So this was the driver of the inflation, and it takes 12 to 24 months to work its way through the system for that inflation. Put this all back in this picture there. So it takes about 12 to 24 months. So this mid-cycle wobble, the housing starts didn't go up. They were increasing interest rates back here. They lowered interest rates back down for the crash of 2001, and then they blew up the housing market bubble. I think that's going to be very similar. I think that we are in a mid-cycle, big mid-cycle wobble, and then we could get a rollover, they lower rates, boom, and then they push into another increasing expansionary phase of real estate. That's a possibility. I don't know if we're going to get how big this slowdown will be. If we get a slowdown, don't know on that particular end of it. But this looks very similar the way that this is moving to this mid-cycle wobble here, kind of just moving sideways. And we're still underbuilt. We have low inventories. There's a lot of building in the pipeline. And I think that's what's going to drive this up. And housing starts generally roll over before a big, great financial crisis. I don't think we're going to have a great financial crisis because of the strength in the housing market at this time. That's my guess. This is a really good uranium thing that I want to read here. So, Rob, it says, to my surprise, I just realized that there's a view that the uranium cycle has already run its course. This could not be more wrong. I was arguably the top uranium analyst in the world for the better part of the decade. I used to co-manage the world's first uranium-focused fund in 2007. I now sit on the boards of a producer and a developer of uranium, one of which is among the lowest cost producers around, and the other being a top 2 undeveloped asset. While I was an analyst, I always predicted that we would go past $100 a pound and for peak pricing to be somewhere between 120 and 150 a pound. I may have made the call too early, but the thesis stands. It is hard to produce uranium. It's arguably the most regulated and the most difficult to socialize with locals. Very few mines ever go into production. It's really just been a small handful since I started looking at uranium in 2004. Those of you who believe that there is a lot of supply coming online are being gullible. I firmly believe this cycle is going to be the big reveal of who can actually produce as opposed to saying they will. Outside of the difficulties listed above, the nearly 2 decades worth of bad markets has led to very few experienced uranium mining people. Anyone looking to produce may at best have a 70-year-old former Camco employee at the helm and little other experience below him or her. This cycle is going to be a reckoning, as pretenders are forced to actually produce. Many won't make it or will manage to eke out fractions of what they promise in terms of production. And that's the end of his rant. I think this is fantastic. And, that's the same thing that I would see at my workplace. Very few people knew what the heck they were doing, and a bunch of other people were just pretenders. Well, that's going to occur this cycle. We're going to have to put a lot of people into producing uranium, and the pretenders are going to get, we'll see who's who coming out here. Totally agree. WTI net long positions fell minus 76% from late September through early December, but have increased in the last 2 sessions and are now down 60%. Open interest has fallen minus 16% since early September. So you can see in the red line here that this has fallen quite a bit for open interest. And net long was really low in December 8th. You can see all these very low times in history. So this is this is beginning of investor flight from 2018 all the way down to 2020. Investor flight from 2021 all the way down to where we are today. So I think the negativity and the negative sentiment is probably going to try to bottom here in oil at some point over the next few months. That's kind of my guess. Uh, and remember, in my opinion, credit is what drives this. And what they did is they punched credit into the system in 2020 to drive this higher. And then we've got another credit slowdown. And that credit slowdown is what could be impacting oil here in the short term. Remember, China is in a massive problem, and they're trying to basically flush out a lot of bad debt right now. They have a deleveraging event in their real estate market, which is really impacting, I think, demand for everything. And that's where I'm going to stop it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel if you haven't already. And we've got that training session coming up on Wednesday at 8:30 a.m. Just as a reminder, if you're a part of the community and want to join. It will be recorded, and don't worry, I'll put it on the website after we have it. All right, guys, that's what I've got for today. We'll catch you later. This is Finding Value.